When it comes to paying taxes, don't hate the player, hate the game. Keep listening as we discuss how to minimize capital gains taxes. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you had learned in medical school. I'm your host, Dr. Jimmy Turner, and here is your co-host who is currently nursing a broken bicep, Justin Harvey.
I'm actually very discouraged, Dr. Turner, because I got an MRI the other day. You know, a few $100s to go to the PCP for the referral, a few $100s for the MRI, a few $100s for the read. Which, by the way, quick user tip that I picked up from some of my friends who are like in the independent health plan space, to just write in on your patient consent, which basically, like, whenever you sign in, you're signing your life away to say, I promise to pay whatever you bill me. I have gotten in the habit of putting a little carrot after I promise to pay whatever you bill me, carrot, as long as it doesn't exceed 2 times the Medicare rate, which creates this sort of sanity check. What I actually found, and this is a little rabbit hole, but you just lit the fuse, so it's going to go off here. For my MRI, I was looking up the CPT code for, right elbow, no contrast, and it was something like $272. The commercial insurer with which I am contracted, in all of their, wisdom and profitability, negotiated a rate that was about 8 or 9 times what I would be paying if I was, or what the fee to the imaging center would be if I was on Medicare. So I paid about $270. My insurer is going to pay the imaging center about $1,800. So the bottom line is, on this sort of patient financial disclosure, I haven't actually gotten in an argument with the billing people about this when it sort of comes full circle. But if you ever are in that place, then you have some sort of legal, and I'm not a lawyer either, but you can at least say, I didn't say I'm going to pay you anything. I said I'm going to pay up to 2x Medicare. And if you're charging me 10x Medicare because my commercial insurer is, negotiating on my behalf a price that's way in excess of what is reasonable, then I'm not going to pay that price that's in excess of what is reasonable. So this is, for the consumers. Obviously, most physicians here are on the other side. And sorry for any private practitioners who are needing that 10x. And this is complicated, and I understand there's different stakeholders here, but I'm just never going to pay that $1,800 balance. I'm just never going to do it.
I'm just thinking about the practical application of this, because when I go to sign those things, it's always on an electronic pad. And I'm pretty sure that the only thing that I could fit is my name. Like, there's no ability to...
You can request it in a paper copy. You'll just really piss off the person behind the desk, but that's what I would do.
I might do that because I've got some upcoming medical expenses myself. But yeah, no, that's an interesting one. And hopefully the bicep turns out okay.
So that was the point. Was the scan was negative for everything that they looked at on the right elbow. So now I'm stuck with, like, I can barely lift my cup of coffee. My right elbow really hurts. The MRI didn't show anything. So now I got to do an ortho consult and continue down the rabbit hole.
You can just use your left hand.
Yeah, that's what I've been doing so far.
I'm just kidding, man. That was mean and insensitive. Well, hey, so this show, we're going to dive into another listener question. And for those of you listening, thanks so much for resending these questions in. They've been great. Really enjoyed chatting with Justin about these topics. And so if you have other questions, other topics you'd like us to consider, I mean, that's exactly what we've been doing several of the last few weeks. And Jimmy at moneymeetsmedicine.com, send them my way. Happy to answer them. And your question is likely to make it on the show. We haven't turned one down yet, although we sometimes change the flavor of them just for anonymity and things of that nature. Before we dive into this listener question about capital gains and taxable brokerage accounts, don't forget, if you want to snag your free copy of the Physician Philosopher's Guide to Personal Finance, you can do so at moneymeetsmedicine.com. Please share that book. I wrote the book for medical students, residents, early career attending physicians. It's super helpful. It is completely free and full of the things that I would have wanted to know when I was on that journey. So you can get your free copy at moneymeetsmedicine.com. And again, please share it with other medical professionals, physicians that you also know as well. So Justin, I'm going to read the question before we dive in, and then we can chat about it. I think there's a lot of different directions this could go. So here's the email I got. I thought a good podcast would be to go into a little more depth on taking money out of a taxable account. I know you've talked more about using the taxable account due to yields and ability to move that money around for lots of things that may come up. I have some ideas, but what happens when you need that money? What shares should you sell first? What is the cutoff for taxable gains? When and how do you pay that taxable when it comes due? I've got some ideas, but what happens when you need that money? What shares should you sell first? What is the cutoff? So on. And I thought this was a great question for lots of different reasons. And listeners probably know at this point that I'm a fan of taxable brokerage accounts. I know that you're a fan of taxable brokerage accounts. And for me, a big reason for that, just for new listeners or people that are joining the community, I love the flexibility of a taxable brokerage account. And I'm going to be honest, I actually had a meeting with my accountant an hour before this call, and they asked me about backdoor Roth IRAs. Hey, Jimmy, you still doing that? And I said, actually, I'm not. I'm preferentially placing money into a taxable brokerage account just for flexibility purposes. And I've become such a fan of this that even mathematically, that decision probably doesn't make sense because capital gains tax rates that we're going to talk about here in a second are 15% on a brokerage account for my family's income. And the early withdrawal penalty for a Roth IRA is 10%. So theoretically, I'm costing myself by choosing the brokerage account if I did need the money. But I just love the flexibility of it so much and the ease of access and the ability to just do all of the things that it does that I love the brokerage account. And there are many other reasons as well. But Justin, you're a fan too, right?
Very much so. I would say the taxable brokerage account is one of these places where a good advisor is going to, you're talking to somebody who's as biased as they're going to get, but this is where they can really earn multiples of their fee through expressing sort of their tax aware investment process through the investments that you hold, through the way that you manage tax loss harvesting, charitable contributions through appreciated security gifting, often in conjunction with a donor advised fund. And then, sometimes using a taxable brokerage account to fund a backdoor Roth IRA contribution and tax loss harvesting in the process. That's something else I've done, and a number of other things. So this actually is also going to relate to what we're going to talk about next week, which is the cash balance plan for a private practitioner. And the taxable brokerage account is sort of the next thing, the alternative to a cash balance plan. So if you're asking yourself, should I do a cash balance plan in my practice? If the alternative is a taxable brokerage account, you should really be comparing those two and the merits of tax efficient taxable account investing versus the tax benefit that may or may not come with a cash balance plan in order to understand the big picture. So bottom line, taxable accounts are awesome. If you're working with a good advisor, they can add a lot of value there. And I'm really excited for this topic today.
Yeah. So a good place to start, I think, is capital gains taxes. Like, what are they, and that sort of thing? Because I'm not sure that everybody listening to this is familiar with what they are. They put money into a brokerage account. Maybe they have taxable at the end of the year. They don't really understand how that operates. And so, big picture, because it's really easy to get into the weeds on a topic like this. So that's going to happen inevitably on the show, but we're going to try to avoid the weeds as much as we can, keep it high level. So capital gains, basically it's the taxes that you pay on the money that grows in your brokerage account. And so how that's determined, short-term capital gains, long-term capital gains are the two big buckets. It basically comes down to how long you've held the asset. So if it's less than a year, it's going to be short-term capital gains. If it's more than, I guess the cutoff's technically 365 days or more, it is long-term capital gains. And those are advantageous tax rates. So short-term capital gains, it's like you're making extra money. Took home an extra $100. Your marginal tax rate's 30%. You're going to pay 30% of that $100 that you just made. Not great, right? But if you keep it for 366 days, all of a sudden it's 15% if you're on the lion's share of people listening to this show. And 15% on $100, that's not too bad, right? That's a pretty reasonable tax rate, particularly when you're used to paying 25, 30, 40% on taxes for W-2 income or other salary that you have coming in. And so big picture, short-term, long-term, you want to try to avoid short-term capital gains when, if at all possible, just because long-term capital gains tend to be substantially better. Is that a good way to put it, Justin?
Yes. And the important distinction here is to understand the difference between capital gains and earned income, which is like your wages from your job that you get on a W-2. There's taxes withheld every 2 weeks, every month, or whatever. And that the wages are taxed at what we call ordinary income rates, which are currently 37% as the top margin. So if you bought a bunch of Tesla stock and you held it for a week and it went way up, and then you sold it, because it's a short-term capital gain, if you're a high income earner, a short-term capital gain is taxed at the ordinary income rate of 37% to the Fed for you. Whereas if you held that for a long term, 1 year or more, then you would be at a different tax rate. That it does get, there's more complexity to it, but it's either 15 or 20%. And then there's an additional charge depending on how much money you make. So it could be more like 25% all in, but it's still better than 37. So, and again, in talking about where does an advisor help with these things, creating turnover, locking in gains on a short-term basis for a high income earner is something you don't want to do. So this is an important part of monitoring tax efficient investing in a taxable account.
Yeah. So if you're listening to this and you're wondering about the cutoffs, because one of the parts of this question was, hey, what are the cutoffs for taxable gains? The three big buckets are 0%, 15%, and 20%. And so I'm just going to mention these numbers really quick because you're listening to the show. You likely know what your income is. And so I feel like this is the bit of the weeds that you can listen to this while driving a car, doing the dishes, whatever you happen to be doing, and it's still going to make sense to you. So for singles, 0% up until an income of $47,000, 15% after that up until $518,000. And then 20% is anything above 518, basically. And these are rough numbers. I'm not going to give you down to the dollar amount because it's just obnoxious. If you're married, 0% goes up to $94,000. And then from 94 to 583, it is 15%. And then it's 20% above that. And so if you're listening to the show, there's a really good chance that you're in that 15% bracket. Okay. And this income is calculated after you take out what you're contributing to your 401k, so your gross income minus your 401k, your 457, your cash balance plan, all the different tax advantage accounts that you have, potentially your deductions. And so it's pretty reasonable to be able to get down to that 520 to 580 number for a lot of doctors and put you in that 15% long-term capital gains bracket. So the big cutoffs there are 90-ish if married, and then 580 if married for the 0% and the 20% bracket. And I actually remember reading a post. My buddy Leaf Darling, listeners may or may not know Leaf from Physician on Fire. He's since sold Physician on Fire and moved on to greener pastures. Great guy. He wrote this tax post that I read several years ago. I think the name of it was "The Tax Man Leaveth," and the purpose of the post was basically to highlight how you could avoid paying any taxes at all on money coming out of your taxable brokerage account in retirement. And he gave lots of different examples for reducing your income that's used to calculate that, to determine your tax, taking Roth money out because it's already been taxed, it's not going to get taxed again, and just several different maneuvers that could be made to essentially bring home $100, $120, $150,000 in income and still pay 0% because you're getting your number below that $100,000 ish for a married couple. And I remember reading that post and being like, that's really cool. And someday when I'm in retirement, I want to play games like this so that I don't have to pay taxes on the money I'm taking from my brokerage account too. So this can be played well if you do it right.
Absolutely. And one of the concepts you're going to want to understand as you're thinking about tax efficient drawdown and the implications thereof is what's called a tax lot. So every time you buy a group of securities with a chunk of cash, you create a tax lot. That means a certain security on a certain date at a certain price. You're setting your basis. So you might only, if we take the simplest possible example, maybe you're just holding the S&P ETF and you just buy that IVV every month. You're dropping in, I don't know, $10,000, buy, $10,000 at whatever the price is. If you do that for 20 or 30 years, you're probably going to have a lot of money after several decades, but you're going to have many, 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 many different tax lots. So even though you've invested a total of $2 million and it's grown to $5 million, what you're going to find is that there's a bunch of different entry points that the investor has created because of investing over time. So one of the questions that the listener asked is sort of, how do I, minimize taxes on the drawdown? You may have a portfolio that ultimately has grown substantially from 2 to 5 million, 2 million of net investment additions that has grown to 5 of total market value at the time that you want to begin to access it. And yet you will likely have, this is less likely if it's an ETF. It's more likely if it's a separately managed account where you've got a bunch of individual securities. But you're probably going to have some tax lots that actually you might have even purchased at higher than the current market value. What that means is some amount of that 5 million can be accessed not only without adverse tax impact, you may actually be able to tax loss harvest if you bought at a higher price point than the market is today. So this may be a meaningful sum of money that you can access without even worrying about any capital gains. So the first question you always want to ask is, if I need an amount of money, do I even need to get into the gains calculation at all? Or can I just take something that's at a loss because of where that price point was set whenever I created that tax lot and then, create a capital loss?
Yeah. So if you're not in an SMA, which we talked about recently on the direct indexing show, for those that don't know what a separately managed account is, the route that I went recently to do this for donor advised fund was use spec ID or specific identification, which is looking at the specific identification of the tax lots. And that allows you to identify the ones that are at a gain or at a loss if you're trying to tax loss harvest or if you're trying to give to a donor advised fund appreciated gains. The point is that it's all about the basis and where you bought that money compared to where the price is now. And so just to give some context to this, there is some other things to there is that's I say this all the time. I'll be like, hey, where's my shoes? And my wife corrects me all the time. She's like, where are your shoes? And so she's a reading teacher in fourth grade. And for whatever reason, I grew up and it was just where's whatever, even if it was plural. So I feel like I just did that publicly to thousands of people, which is great. So yeah, so if you're sorting through this, right, we talked about the brackets. We talked about the taxes, long-term, short-term capital gains. When it's which to sell first, it really kind of does come down to that tax lot, which was a part of this question. And one part of the question, Justin, I'd be curious to know. I didn't really. I probably needed more context on this, and maybe I should have emailed back and gotten that. But the question was, when and how do you pay the tax bill when it comes due? And so part of me was like, well, you pay your taxes when you pay your tax. I mean, I guess you could pay an estimated taxes on your gains, but I'm personally a big fan of hanging on to as much money as I can and letting it work for me in even a high yield account or a money market account, or God forbid I invest it in equities or something like that because I have enough money laying around to pay the tax bill at the end of the day from other sources. But I thought this was an interesting question because I think there's multiple ways to do this.
Yeah. So I'll give you my opinion on this. And this is not tax advice because I'm not a CPA or tax advisor, but a lot of what we do interacts with our clients' taxes. So the first question I would ask if someone was going to realize a meaningful amount of gains from their taxable investment account is, are we in safe harbor territory? So there's a couple of different safe harbor tests for income taxes, for federal income taxes. And for our purposes, I'm going to oversimplify and say it's either 90% of the current year or 110% of the prior year total liability gets you to safe harbor. So, and Jimmy, I think we can throw a link in the show notes to the recent conversation we had on this topic, which is really important, especially if you're a business owner and you've got a moving target and you're doing quarterly payments, and you're trying to sort of land the plane on the aircraft carrier with a crosswind and the seas are sort of making everything shift. It is a moving target. But if you're going to achieve safe harbor through either one of those tests, then you just pay in April. If you're going to realize an amount of gains that is so significant that it pushes you out of safe harbor, meaning I expect to make $500,000 this year, and I paid $100,000 of taxes last year to the Fed. If this year my total paid in is 110 grand, that's 110% of the prior year is $110,000. If I've paid that in this year, then I can realize $1 million of gains and not have any interest or penalties assessed because of the prior year safe harbor that I have met. But if I'm only at like 100,000, then I need to see, am I going to hit the 90% test, which I wouldn't because I've got an extra $1 million of income that I've realized and not paid taxes on, and I don't hit the prior year. So you need to make sure that you hit one of those two tests in order to pay in April. If you don't meet one of those two tests, then you need to do an estimated payment to recognize that, I just made $1 million of gains that have been unwithheld upon. It's not like when you get your paycheck and payroll sends money to the Fed and the state, and then you get the net. It's if I bought Tesla at 100 and it grew to 10,000 and I sold it, I get $10,000 in my brokerage account. I've got all of the money, and Uncle Sam has an IOU on that money, but he doesn't take the money as soon as I place the transaction. It's up to me to understand the safe harbor and then to make an estimated payment if necessary.
Yeah, and that matters because in your example, let's say we paid 110% of the prior year's taxes. We had $100,000 in 2023, and in 2024 we paid $110,000. And all of a sudden, all of that money that's above that is free to play with, right? And so that $1 million, you're going to get taxed on it. So you decide to stuff that $1 million in a high yield savings account or a money market account or some other location, and you earn money on it for the next 12 months before you pay your taxes, right? Now you have, let's say, a 20% capital gains. You have to pay on that $200,000 on that $1 million you earned. But during that time, you let it grow at 5%. And now you have, you're not paying $200,000 anymore because you've now earned $50,000 off of that money. Now your tax bill is 150 grand based on the net there. So Safe harbor, I'll link to what that is, maybe in a podcast or not a podcast, a post or IRS link to let you read about the safe harbor rules if you want to learn more about that. This comes into play for capital gains. It also comes into play for people that have 1099 or private practice income. And I've shared this story on the show before, but it's just so mind blowing that I share it more than once. Which is the doc that I had a friend who had a partner when he was in private practice that didn't realize that he had to pay estimated taxes during the year, and so at the end of the year got there and did have a six-figure sum of taxes that were due that he hadn't paid any money on and he hadn't saved up for. And so he had to basically create a payment plan with the IRS to pay the money back, obviously with penalties. And in that situation, he just didn't know about estimated taxes at all. And so you need to know about estimated taxes. You need to know about safe harbor rules and how those kind of play into your situation if you're selling gains in a taxable brokerage account. I think that's an important topic.
One additional dynamic to be aware of here is, especially if you have a globally diversified allocation in a taxable account, often asset classes move in lockstep, meaning all the international developer, all the emerging markets, or all the, pick your asset class will act similarly over a period of time. So what you may find is if you're like, oh yeah, let's sell the stuff that's at a loss or at a modest gain in order to keep the tax bill down, that's all well and good. And frankly, that's usually the first step. But the next step is, what does my portfolio look like now? And often what you're doing is you're blowing out of an entire asset class or of a only one asset class. Maybe you're not eliminating the whole asset class, but you're taking a big bite out of it. And your portfolio is now sort of composed of something different than it was before you placed the sales. So you want to think about rebalancing, or you want to think about, if I'm adding new capital to the portfolio over time, to intentionally be managing back to those strategic allocation targets to make sure that you're not taking some weird kind of risk. Or really, probably what you're doing is because of the idea of mean reversion, which I call the law of financial gravity. What goes up must come down, and also what goes down must return to its long-term average over time, except it doesn't actually have to. And we don't know how long of a time that is. But the reason that it interacts with this question at hand is, if something's going down, 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 and then I sell it because I want a tax loss harvest, the mean reversion reality means that if this thing is really depressed in terms of price, or this asset class is really depressed in terms of price, I actually want to make sure I'm still exposed to it, because that's where my portfolio is going to get the pop. So if you're doing this tax loss harvesting in order to capture some cash from your taxable portfolio, just be aware that you may actually be removing yourself from the asset class with sort of the most appealing characteristic, just because it's been hammered all the way into the dirt. And you want to make sure that you're on board that rocket ship whenever it returns to its long-term average.
Yeah, buying stocks on sales is something that I'm a big fan of. And I think the way that you should frame that mentally so that you have the ability to buy when it's low. And it's also worth noting, just because you mentioned it, the tax loss harvesting is something in this situation that would really come into play and help you out a bunch. And so if you had that $1 million, and I'm not saying you're going to tax loss harvest $1 million, but the example we gave earlier, you have $1 million in capital gains, tax loss harvest $1 million. You can put those two things together and pay zero taxes in the year in which you've done that, because you carried those taxes forward. And so tax loss harvesting is another thing to think about, specifically, like you just mentioned, Justin. So the timing, you got to consider the tax loss harvesting, you got to consider rebalancing, several things to kind of keep into mind. And then there are ways to help reduce this by playing the game, if you will, particularly in retirement, to get yourself back down into a lower bracket if you are able to. Justin, anything else that we left out we need to hammer out before we get out of here?
There's a less common circumstance for many of your listeners, but it is a little more common for transitioning physicians who are getting into those like latter 50s, early 60s, maybe transitioning out of practice, maybe taking some time to either be retired or semi-retired before the Social Security and RMDs kick in. And you may actually find that as a physician or former physician, you're in that zone where you're not going to hit the $100,000 of income. And so instead of tax loss harvesting, sometimes we see an opportunity for tax gain harvesting, where embedded taxable gains can be realized with no tax impact. It's 0% taxable gain. And so during that period of time between, age 60 and 70, while we're thinking about Roth conversions and doing the retirement planning and all sort of understanding where the income is going to come from in your latter years, there are times at which it makes sense to realize gains on positions that have appreciated, especially if you're not going to gift them, to reset basis at a higher level so that you can then sell them when you're 70, 80, 90 and realize even less gains at that time. So it's a tactical thing that only applies to some people, but when it does apply, it's free money. And anytime there's free money in play, we want to make sure that we bend over and pick it up.
Yeah. And you just actually reminded me something I wanted to mention on the show before we head out, which is that unlike ordinary income taxes, which are progressive in nature, where you pay at the 0%, then you get to 15 and then 22, like pay pieces along the way. But all of your monies, it's not like if you land in the 37% tax bracket, you're paying 37% on all of the money that you've earned. Whereas in capital gains territory, it actually does work like that. If you get to the 15% number in terms of income, you're paying 15% on all of your gains. It's not like you pay 0% on the gains up until $98,000 and then you pay 15. It is a threshold.
That's right. Yeah, an important thing to keep in mind.
Thanks to this listener for sending in this question. Jimmy at moneymeetsmedicine.com. If you want to send in your topic, your question, we love answering these because it's exactly what you want to hear about, which is what we're all about. Before you head out, don't forget to go on to moneymeetsmedicine.com, download your free copy of the Physician Philosopher's Guide to Personal Finance, or look into own occupation disability insurance, which we can provide from all the companies that do that. That's really important to us. And we're super passionate about what we've been able to accomplish at Money Meets Medicine Disability Insurance, helping docs get the help that they need and honestly saving a lot of people from some pretty bad situations along the way. So thank you for those that have trusted us and appreciate you sharing the show and being a part of the community. We will see you next week. Cheers. Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.